when you're sitting as a macro investor, what I mean by macro investor is an investor who's primarily focused on the returns of, country level equity indices, bond markets, currency markets, commodities, et cetera, not individual stock picking, but
Mm-hmm.
sort of the overall index style investing. What you learn through that process is that there are sort of fundamental cause effect drivers, particularly tied to the macro economy, that drive macro asset market returns. And so I think one of the key things is really helpful in terms of my development as an investor is developing that sort of rich, deep understanding of the macro connections. So why would bond yields move up, or why would they move down, or stocks move up or stocks move down? A lot of times at the macro level, those are driven by sort of these fundamental properties of the economy, which, for instance, whether growth is getting stronger than people expect, or inflation is lower than people expect, or monetary policy is tighter or easier than people expect. Those different underlying core drivers then are reflected in what goes on in macro asset pricing. And so in a lot of ways, I think macro markets really is a really useful lens, because it allows you to connect the big themes that are going on in the economy to market returns that give opportunity for betting, or what we call generating alpha over time.
Yeah. So you said that there are these like connectors, and you brought up inflation, growth, monetary policy. Is that how you think about investing in these different asset classes? And you kind of look at their relative performance, and that's how you kind of construct a portfolio? Is kind of you start there and then move out?
Well, I think it's important to think about, whenever you're investing, there's basically two sources of investment return. One is what we call beta, which is passive investing, which means if you buy stocks, stock market, you would expect over time for that to have a positive return, right? Because if it didn't, why would you ever buy stocks? Why would you ever give a company your money through equity issuance? And so the key things to think about for beta, is what we call it, is to think about how do you balance your portfolio to most effectively be sort of balanced to different macroeconomic environments. So sometimes inflation is going to be high, sometimes it's low, sometimes growth is strong, sometimes it's weak. And how do you make sure that you don't get overweight on one particular outcome or another? The other side of generating returns is something called alpha. And what alpha is basically taking bets in markets, right? So saying, I think, the market pricing is a certain thing. For instance, if you think about the Fed right now, the market is pricing the Fed to cut 4 times in 2024. You can either think that that's too much or too little or just right. And that view relative to what's priced into the market is what generates alpha, right? If you're right, then you make money on that trade. And if you're wrong, you don't make, you lose money in that trade.
Exactly.
And so you want to think about those two things differently. For beta, it's about balance. And for alpha, it's about really understanding those macro linkages and comparing them to the market pricing to see where there are opportunities, where the probabilities that are priced into the markets are inconsistent with the probabilities in the macro economy.